Hello students, welcome to Byju's IAS. Welcome to a session on economy this week, wherein we'll be taking up some of the very important articles that have appeared in various business related newspapers and we'll be analyzing these particular articles. For this particular video, I've taken up the time period from 24th to 30th of June 2019 and the articles that I've picked up are from Business Line, Hindu, Business Standard, Indian Express, LabMint. So let's begin this particular discussion. The first article is related to agriculture subsidies. Government of India provides a huge amount of agriculture subsidies, be it in the form of fertilizer subsidy, in the form of minimum support price, in the form of electricity subsidy, so on and so forth. The total value of these particular subsidies, which are given by Government of India, have kept on increasing over a period of time. For example, the article quotes that for the financial year, the total value of agriculture subsidy incurred by the government was somewhere in the range of 1.8 lakh crore rupees, which ballooned to more than 40% in the financial year 19 to more than 2.5 lakh crore rupees. And for the financial year 20, it is expected to cross 2.7 lakh crore rupees. Now, what are the issues with respect to these kind of agriculture subsidies? First, please understand, whenever Government of India gives these kind of subsidies to the agriculture sector, it will ensure that the agriculture inputs are available at a cheaper cost for the farmers. And since these particular inputs are available at a cheaper cost for the farmers, it has been seen that there is inefficient usage or there is abuse of these particular resources. For example, electricity consumption in case of agriculture sector has been made free of cost in some of the states. As a result of this, it has been seen that there is reduction in the groundwater level. So there is a certain abuse of certain resources and there is inefficient utilization of these particular resources. Second, whenever Government of India incurs these kind of subsidies, the government revenue expenditure will increase. Not only this, since Government of India has already provided the support to the agriculture sector in the form of these particular subsidies, the money that is left with the Government of India to incur in the form of capital expenditure in the agriculture sector becomes lesser. For example, let's say hypothetically, Government of India provides agriculture subsidy of 100 crore rupees in the form of fertilizer subsidy. Rather than giving this particular fertilizer subsidy, Government of India could have used this particular 100 crore rupees to develop infrastructure such as storage, warehousing, grading and sorting infrastructure in India. Because in case of the APMC yards, it has been found that there is a huge lack of infrastructure facility in these particular yards. So since Government of India is incurring the expenditure in the form of agriculture subsidies in one form, they are unable to have an expenditure under the investment or under the capital expenditure. And another issue with respect to these kind of agriculture subsidies are, since there are subsidies which are provided by the government, there are inefficiencies created in the market. Let me elaborate on this. I'll take a very simple example of MSP, minimum support price. In case of the government, it announces MSP for more than 20 agriculture commodities. Though Government of India announces for more than 20 agriculture commodities, it doesn't procure all these particular commodities. It majorly procures rice and wheat so as to ensure that there is sufficient amount of food grains for public distribution system. Now imagine you are a farmer. Government of India announces a huge hike in terms of MSP for rice and wheat, and the moment government announces this particular huge hike of MSP, these particular farmers, rather than cultivating any other crop, will shift to the cultivation of these particular crops, such as paddy and wheat. And the moment cultivation shift happens, the cultivation of other agriculture commodities will take a hit. For example, cultivation of pulses. So when the cultivation of these agriculture commodities, such as paddy and wheat, increases, the supply of these particular commodities in the market will obviously increase. Because whatever is produced is not procured by the government. Majority of it is supplied to the market, and since there is a huge supply to the market, the prices will start coming down. And on the other side, cultivation of pulses will get hit, supply of pulses will come down, and since the demand in the market is higher, the market prices of the pulses will start increasing. So it will not only affect the cropping pattern in India, it will also affect what is the return of the farmers in the market. This is one of the reasons why the farmers do not get a fixed return, or there is a volatility of returns earned by the farmers in the market. So these are some of the issues which are associated with the present subsidy regime of the government of India in the agriculture sector. So what is the way out? Way out is direct benefit transfer. But there is an issue with the direct benefit transfer also. Because let's say under direct benefit transfer, we start providing the subsidies to the farmers, such as fertilizer subsidy, electricity subsidy, so on and so forth. But these particular subsidies under DBT regime will not resolve the structural issues which are affecting the agriculture sector, such as availability of infrastructure. So look at this. On one side, I want to increase the efficiency of these particular subsidies. So the recommendation is shift to the direct benefit transfer regime. But even if I shift it to the DBT regime, structural issues in the agriculture sector will not be addressed. So there has to be a balance of policy. What is the recommendation which has been provided in this particular article? Some of the very important recommendations are: 1. Do not provide agriculture subsidy to all the farmers. Best example is fertilizer subsidy. In case of India, the fertilizer subsidy is a universal subsidy. That is, all the farmers will get access to fertilizer subsidy, irrespective of whether the farmer is small, marginal, large farmer. But in reality, it is the small and marginal farmer who actually needs these kind of subsidies. So start targeting these particular subsidies. It will reduce the subsidy outlay. That is first recommendation. Second recommendation, whatever subsidies you give, bring them under the platform of direct benefit transfer, so that leakages which are going to happen are going to be plugged. Third, link your subsidies with the size of the land. And fourth, once you have ensured that all these are done, over a period of time, start scaling back these particular subsidies. Rather than giving the subsidies to the farmers, utilize this particular amount in developing infrastructure in the agriculture sector. These are the 4 very important recommendations which have been provided in this particular article. Apart from this, another very important point I want to mention related to agriculture subsidies is a concept of agreement on agriculture. That is, under the ambit of a WTO, World Trade Organization, India is a signatory to agreement on agriculture. And this particular agreement on agriculture has a concept of a de minimis level. In the recent times, a lot of discussion is happening related to this concept of a de minimis level. This level basically regulates what should be the support in the form of subsidies given by the governments to the agriculture sector. I'll repeat the statement. De minimis level basically discusses what should be the support that is given by the governments to the agriculture sector in the form of subsidies. In case of developing countries, the regulation says it should not cross more than 10% of the total value of agriculture production. In case of the developed countries, it basically says it should not cross more than 5% of the total value of agriculture production. Now, what is the connection between this with this particular recommendation of the article? One of the recommendation was you will have to scale back over a period of time the subsidies which are given to the farmers and invest this in the form of a development of infrastructure. Now, various developed economies such as USA have argued that Government of India gives a huge amount of subsidies which are under the de minimis level not allowed to the agriculture sector. One of the ways of overcoming this particular issue will be if Government of India scales back these particular subsidies and uses this money to develop infrastructure which will again assist in getting the income for the farmers. So this is the gist of the article. Let's look at the question based on this. The term de minimis often appearing in the newspaper is associated with, we have already seen this, it is associated with agriculture subsidies. Now, based on this particular discussion of subsidies, I just want to give you a descriptive question wherein you will have to write maximum 250 words. The question is, subsidies are politicians' delight and economists' nightmare. Elaborate. So these are the questions related to this article. Let's look at the next article. It is related to India and RCEP. RCEP is nothing but a proposed multilateral grouping of 16 countries, of which India is one of the country. Now, this particular proposal was for the first time given in the year 2012 by ASEAN, and since then there have been deliberations which are happening. Now, what is the update which has been given in this particular article? Very recently, the member countries have come together and they have decided that by 2019, they want to finish the discussions related to formation of RCEP. Whatever issues are there, they want to iron them out, and they want to ensure that by the end of 2019, they want to conclude the negotiations with relation to this particular agreement. Now, since the beginning, Government of India has been raising certain issues against the proposal of RCEP. Some of the very important objections which have been raised by Government of India are associated with allowing free flow of cheaper goods into Indian market. In simple terms, once the RCEP is signed, Government of India has to take off or has to withdraw the import duties that it has imposed on many of the cheaper imports. The moment the Government of India will withdraw these particular taxes or customs duties or import duties, these particular cheaper imports, especially from China, will start flowing into India, and it will basically affect the domestic manufacturers. So this is one very important concern which has been raised by Government of India. Second very important concern has been associated with the services sector. Government of India has been stating that it wants other countries to freely allow the flow of the human capital from India to their countries. In simple terms, so whatever barriers have been put in place by various other countries which are regulating the flow of the manpower from India into their countries, these particular barriers will have to be withdrawn. Third important concern which has been raised by the government is related to origin country. That is basically Government of India saying whenever the goods are manufactured in one country and sent into another country, especially when they are imported into India, these particular goods will have to be tagged with the origin country. In simple terms, Government of India is worried that some of the countries may simply start routing their goods from other countries. Let's say, for example, the good is actually manufactured in country X. It will basically send it to another country Y, have a small value addition, then send it to India. But essentially, this particular country has exported these particular goods into India. So Government of India says whenever under RCEP, these particular goods will enter into India, that is imported goods, these will have to have a label of origin countries so that Government of India comes to know actually from which country these particular products are originating. So these are the three very important concerns which have been raised by Government of India in the deliberations or the negotiations for RCEP. Now, why Government of India is so much concerned? Government of India has a trade deficit with 11 of these particular RCEP countries. That is one. Second, Government of India has entered into FTAs with many of these particular countries. But the experience of Government of India or the overall experience of these particular FTAs has been negative in case of India. In simple terms, whenever these particular free trade agreements are signed, we expect the exports from India to increase and the trade deficit to come down. But in case of India, it has been seen that with signing of these particular FTAs, the trade deficit with these particular countries has actually increased. In simple terms, rather than getting the benefit from these particular FTAs, India is negatively getting affected from these particular FTAs. These are the two very important concerns. Apart from this, the third important concern is India already has a huge trade deficit with China. And if under RCEP, India is forced to withdraw these particular import duties or tariffs which they are imposing on Chinese imports, these particular imports may suddenly surge, which will basically flood the Indian market, affect the domestic manufacture. So these are the three important points based on which Government of India has laid down certain concerns in case of RCEP negotiations. So this is the gist of the article given here. Now based on this, let's solve a question. Consider the following statements. India has a trade surplus with all the members of proposed RCEP. Wrong. India is a member of SAARC as well as ASEAN. India is a member of a SAARC but not of ASEAN. So second statement is also wrong. Right option will be option D. Both are false. A descriptive question based on this. In the current climate of volatile international trade climate, despite all of its concerns, multilateral grouping provides an opportunity to India. Evaluate 250 words. The next article is related to GSP benefits to India. Now GSP basically stands for Generalized System of Preferences. Under this, the developed countries provide a tariff benefit to the exports which are coming from developing countries. I'll repeat the statement. Generalized System of Preferences is a system under which the developed countries provide a tariff benefit to the exports which are coming from developing countries. The developed country basically provides this particular tariff benefit in the form of either very low tariff imposition or nil tariff imposition. In simple terms, these particular exports which are identified which will be given the GSP benefits will either be imposed with very less rate of a taxation or no rate of a import taxation by this particular developed economy. Now, Indian exports have been enjoying these particular GSP benefits which were earlier provided by USA. Apart from USA, there are many other countries which are providing these particular GSP benefits, such as New Zealand, such as Belarus, such as Russia, Australia, most importantly European Union, etc. So there are more than 20 countries which are actually providing this particular GSP benefit to Indian exports. Now remember this, not all the exports from India will enjoy the GSP benefit. There are certain conditions. Based on the conditions, these particular products or items will be identified and only these particular items will be given this particular GSP benefit. Now in case of India, more than 1,900 trade lines or the goods which were sent from India enjoyed a GSP benefit when they entered into USA. But more importantly, these particular value of the goods which were going from India to USA had kept on increasing in the last couple of years. And these particular accounted more than 11% of the total exports from India to USA. And in the last couple of years, these had actually crossed more than $5 billion. Now, apart from this, the information that is given in this particular article is the value of the exports which enjoy the GSP benefits to the foreign countries from India. These are the highest to European Union. And all the other countries put together, the exports are 5 times the value of the exports sent to USA which enjoy the GSP benefit. But very recently, the US government has announced that the GSP benefit or GSP status which is given to Indian exports has been withdrawn. And with this, these particular exports are expected to be affected. So this is the gist of the article. Now based on this, let's have a look at the question. Consider the following statements. Australia, Russia, New Zealand, European Union provide the GSP benefit to Indian exports. Yes, it's true. Second, Indian exports enjoying GSP benefits were highest to US in the last 2 years. This is wrong. Rather than US, it is European Union. So the right option will be option A. Only one is true. Next article is related to corporate tax in India. Now please understand, the companies which are functioning in India will pay a tax to the government. The biggest form of a tax which is paid is corporate tax. But apart from corporate tax, these particular companies will also pay surcharge, will pay cess, and will pay dividend distribution tax. So apart from corporate taxes, the companies will pay all these forms of taxes. The overall corporate tax in India is 48.3%. And when I say corporate tax, the tax that is imposed by the government on these particular companies, apart from the corporation tax, it will also involve these particular taxes. And this particular rate of a corporate tax which is imposed by the government of India is the highest amongst many of these particular countries. This particular survey has been conducted by Organization of Economic Cooperation and Development, and this particular OECD survey basically measured these types of taxes on the corporates in 94 countries or jurisdictions. And this particular survey has basically found that one, the total taxes imposed by the government on these particular corporates is the highest in the world. That is the first. The total rate of a taxation is more than 48%, to be more precise 48.3%. Third, it is more than twice the average tax imposed globally on the companies. So these are the three very important findings of this particular survey. Now what is the inference that you need to draw from this particular survey? Please understand, whenever a company earns profits, it will pay taxes to the government, and whenever the tax rates are very high, the company is left with very less money to invest. Invest in what? Invest in the form of capital expenditure, invest in new projects. So see here, two very important effects are, one, whenever the corporate tax rates are very high, it will affect the capital expenditure of the companies. Second, whenever corporate taxes collected by the government are very high, it basically reduces the risk-taking ability of this particular company by investing in newer projects. Third, whenever these particular tax rates are very high, it becomes very difficult for this particular jurisdiction or economy to attract foreign companies. And Government of India has implemented a lot of measures in the last couple of years under which they want to attract these particular foreign companies. Best example is Make in India, wherein Government of India wants to promote foreign investment as well as a domestic investment in the manufacturing sector. Now, if you are a company of foreign origin, you are thinking of whether to enter or not into the Indian jurisdiction or Indian territory. And when you realize that this particular government collects a huge amount of taxes from you, you will make a decision to invest in other countries compared to this particular country. And fourth and very important impact of this particular high tax rate is that whenever Government of India imposes and collects a huge amount of corporate taxes, it will affect the international competitiveness of this particular company. So these are the four negatives or four issues which are associated with very high corporate tax collected by Government of India. So this is a gist of the article. Now let's have a look at the next article, which is associated with the savings and investment. Please understand some of the basics here. Let's assume here is a person X who earns 100 rupees. Now out of 100 rupees, let's say hypothetically, he will use 40 rupees for the immediate consumption. We'll basically call this as expenditure. And the remaining 60 rupees, we will call this as savings. Now this particular component of a savings is very important for us. Why? These particular savings usually are in two forms: financial savings and physical savings. The basic difference between financial savings and physical savings is usually the physical savings are invested in physical assets such as real estate, gold, whereas financial savings are invested in the form of fixed deposits, savings bank account, so on and so forth. Now what is the importance? Importance is whenever this particular money, let's say hypothetically 60 rupees is kept by this particular person X in a bank, in whatever form, the bank will utilize this particular 60 rupees to issue it in the form of a loan. To whom? Let's say to a company. Now once the company has taken the loan from the bank, it will purchase, let's say, raw materials from the market, it will purchase a machine from the market, and using this, it will start the production or increase the production. And whenever the production increases, we basically say the GDP is also increasing. That is a basic connection between the savings as well as the growth in especially the developing countries. In simple terms, they will say that there is a very strong correlation between the savings and growth in developing countries. Now this is one very important basics. Second, these kind of savings are done by households, are done by companies or firms as well as government. In case of India, majority of the savings comes from the households itself. That is usually more than 60 to 65% of total savings comes from the households. And whenever the household savings takes a hit, it will have an impact on total savings of the economy. And these particular savings will get converted into investment in the market. But please understand, apart from the domestic savings, there is also a component of foreign savings. Best example is FDI, a foreign company coming into India, investing in, let's say, manufacturing. That is no doubt a form of a foreign saving which will add to the investment in the domestic market. So, in India, the total investment will not only come from domestic savings, will also come from foreign savings. That is very important for you to remember. And this particular investment, whenever we compare this as a percentage of GDP, we call this as gross capital formation. In case of India, post the global financial crisis, it has been found that the savings have taken a hit. The total savings in India were somewhere in the range of 36% of GDP before the onset of global financial crisis, and presently it is somewhere in the range of 30% of GDP. Now, these particular savings have declined precisely because the household savings have come down and the public savings, that is basically the savings from the government, also has declined. This is a cause of concern and the government of India needs to implement certain reforms to reverse this particular issue. But apart from these particular decline in the savings from the household as well as the public, the private sector savings have actually increased. So this is the gist of the article given here. Based on this, let's have a look at the question. Economic growth in country X will necessarily have to occur if A, there is a technical progress in the world economy. Let's say there is a technological progress in USA. Does that guarantee that there is economic growth in India? No. First point is wrong. There is population growth in country. Increase in the population doesn't necessarily mean that there is growth rate. B is also wrong. There is a capital formation in country X. We have already seen the concept of a gross capital formation. And whenever there is a gross capital formation, it means what? Investments are happening in the market. And since the investments are happening, the natural outcome will be GDP growth. So third point, that is point C, is correct. These are the various articles as well as the questions related to these particular articles for this particular time period. Thank you. Have a good day.